92%. That's the share of professional fund managers armed with Ivy League degrees, Bloomberg terminals, and entire analyst teams who failed to beat the stock market over 15 years. 92%. So if the so-called smart money is losing, how are regular people like you and me supposed to win? We cheat. Well, not really cheat, but we stop playing the same losing game. Instead of trying to find the one perfect stock, we buy the entire market. Today, I'm going to show you exactly how to do that using ETFs. I'll explain what they are in plain English, and then I'll walk you through the top 10 ETFs to watch in 2026 to build what I call the simple wealth-building portfolio. Just a quick disclaimer before we dive in. I am not a financial advisor, and this is not financial advice. This video is for educational and entertainment purposes only. Always do your own research before investing your hard-earned money. Let's dive back into ETFs. No trading screens, no stress, no guesswork. But seriously, what even is an ETF? Imagine you're at the grocery store. Buying a single stock is like buying one egg. If you drop it, breakfast is over. Total loss. An ETF, an exchange-traded fund, is the shopping basket. Instead of betting everything on one egg, you buy the basket. Inside it are eggs, milk, bread, cheese, hundreds or even thousands of companies. When you buy one share of an ETF, you instantly own small pieces of many businesses at once. If one company fails, it barely matters. The basket survives. And exchange-traded simply means you can buy or sell that basket instantly on your phone, just like a stock. Low fees, instant diversification, far less stress. Got it? Good. Now let's build the portfolio. We are starting with the foundation. These are the ETFs you build your wealth around. You don't trade them. You let time do the work. Number 1, VOO. This tracks the S&P 500, the 500 largest, most profitable companies in America. Apple, Microsoft, Amazon, Google. When you buy VOO, you're not betting on a company. You're betting on the long-term productivity of the US economy. Historically, that has been one of the best bets an investor can make. Who is this for? Almost everyone. This is the backbone of wealth. Number 2, SPLG. This is essentially VOO with a lower share price. Same S&P 500 exposure, but easier for smaller accounts to buy consistently. Same engine, cheaper entry point. Number 3, VTI. VOO gives you the top 500 companies. VTI gives you everything. Large caps, mid caps, small caps, over 3,700 stocks in one ETF. If VOO is a steak dinner, VTI is the entire buffet. Who is this for? People who want maximum diversification and zero FOMO. Now we step into growth, riding the 2026 tech cycle. Quick note, these will be more volatile. They drop harder in bad markets, but they outperform in strong ones. If you believe AI, automation, and cloud infrastructure will continue shaping the global economy in 2026, these matter. Number 4, QQQM. This tracks the Nasdaq 100, the most innovative companies in the US, heavy on tech, heavy on growth. It will swing more than the S&P 500, but when growth leads, this ETF leads. Number 5, SCHG. This is Schwab's large cap growth ETF. It focuses on companies growing revenues and earnings faster than average, but with broader diversification than pure tech. Think of it as growth with a seatbelt. Number 6, SMH. This is the picks and shovels AI play. Semiconductors power everything. AI models, data centers, cars, phones, defense systems. SMH holds NVIDIA, TSMC, AMD, and the backbone of modern computing. This is volatile, no question. But if the AI infrastructure build-out continues through 2026, this is one of the most direct ways to participate. Number 7, VGT. This is pure technology. No banks, no energy, no consumer staples. Just software, hardware, and IT services. Who is this for? The tech maximalist who believes innovation remains the primary growth engine. If you're finding this useful and want weekly market breakdowns without the noise, consider subscribing. It's free, and it helps the channel more than you think. Alright, let's talk cash flow. Growth is great, but cash flow gives flexibility. These ETFs are about income, not hype. Number 8, SCHD. This ETF focuses on high-quality dividend payers, not just high yield, reliable yield. Companies with long dividend histories, strong balance sheets, and consistent cash flow. It won't double overnight, but it will quietly compound and pay you to be patient. Number 9. JEPI. This one is different. JEPI isn't designed to chase market-beating returns. Instead, its primary goal is to generate reliable income, even when markets are volatile. It does this through a covered call strategy, layered on top of a portfolio of high-quality US stocks. In simple terms, JEPI trades some upside during strong bull markets in exchange for collecting option premiums, which are paid out to investors as income. Historically, this strategy has produced high single-digit to low double-digit yields in many market environments. That said, the exact yield can vary from year to year, depending on market conditions and volatility. What really makes JEPI stand out is that it typically pays monthly, making it especially attractive for investors who want steady cash flow rather than pure long-term growth. Number 10. JEPQ. Think of this as JEPI applied to the Nasdaq. You get exposure to growth names like Apple and Nvidia, plus a monthly income stream. More volatile than JEPI, but also more growth-oriented. In 2026, it remains one of the most popular ETFs for investors who want both growth and cash flow. One crucial warning on these last two. The income from these covered call strategies is typically taxed as ordinary income, not the lower capital gains rate. That means tax-advantaged retirement accounts, like an IRA, are often the most efficient place to hold them so you don't get hit with a surprise tax bill. Bonus: the rate cut play. Before we wrap up, I have one bonus pick for 2026. This one is specifically for an environment where interest rates are falling. The ticker is IWC, the iShares Microcap ETF. We aren't talking small caps, we are talking microcaps. The tiniest public companies in the US, here is the logic. Giant companies like Apple have mountains of cash. They don't care if interest rates are 5%. But tiny companies? They rely heavily on floating rate loans. When rates were high, these companies got crushed. But if interest rates fall and credit conditions improve, their cost of capital declines and they have room to run. Now, a reality check. IWC is volatile. These companies are far more sensitive to economic shifts than a Microsoft or Google. If rates are coming down in 2026, this is the high-risk, high-reward play to watch. Investing doesn't need to be complicated. If you want simple and safe, VO or VTI. If you want growth, QQQM, SCHG, or SMH. If you want income, SCHD, JEPI, or JEPQ. And if you want to play the rate cuts, IWC. The biggest mistake investors make isn't picking the wrong ETF, it's constantly switching instead of letting time work. Now I want to hear from you. If you could only hold one of these ETFs for the next 10 years, which one are you choosing? Drop the ticker in the comments. I read them all. Thanks for watching. I'll see you in the next one.